All and welcome to today's webinar. I was just fixing my camera. Thanks for joining us today. We're on August the 1st, first day of the month. It's been a busy 24 hours in market, so we're going to dig into that in a little bit more today as we give you a quick rundown of what Market Matters Invest is. It's our digital investment solution, and then importantly cover some of our views around the market and answer your questions. We'll have plenty of time for that at the end. I've got a list of questions that have been sent in ahead of time, so we'll get to all of those things and more throughout today's webinar. Can't believe we're now going into FY24 reporting season. Time flies. So these reporting seasons tend to come around very, very quickly. I'm of course joined today by our research lead, Shawn Hickman. I'm going to bring Shawn in now to say hi. And we'll run through we'll have a chat about our views around markets, as well as give you a comprehensive overview of what Market Matters Invest and some of the details around that. So come on in, Shawn.
I'm not sure if you can hear me, James, but it's telling me you need to let me in.
Excellent. Here we go.
There we go.
There he is. You'd think I say it a lot. I'm still have a few gremlins in Zoom. So anyway, we'll get there. Maybe next pandemic, after the next pandemic will be better. In terms of just a quick disclaimer to run through. So before we begin, so just a reminder that all advice provided in today's webinar is of a general nature only. It doesn't take into consideration any one person's personal circumstances. So keep that in mind when you're listening to this webinar, and also keep it in mind when you're looking at the site, asking questions, etc., as members do. Just a quick rundown to give you a quick overview of who the investment team is at Market Matters. It's headlined by me. My name's James Gerrish, lead portfolio manager. I am a senior portfolio manager at Shaw & Partners, been doing this for 20 odd years. Shawn Hickman, research lead on the line there, 30 years experience, worked at some larger institutions before Market Matters, and is going to bring Market Matters up into a large institution over time as well. Shawn, no doubt. Peter Winty, first of all, he's on the investment committee, really well credentialed governance professional, and Peter White on the investment committee as well. Market Matters Invest. So to give you an idea of what I want to set out today, I just want to give you a brief overview of what Market Matters Invest is. For those that don't know, we've got a digital investment solution. So we publish reports. We have a digital advice platform where you can go and get all the information on stocks, and importantly, our views around stocks. So we provide an opinion plus action framework. It's been developed over 10 years that we've been operating Market Matters, and the website is sort of transitioned, morphed, and expanded into that area. So providing an overlay of the fundamental and technical data that is available on a company, and then providing important views around it, what we're doing in that company, the opinion plus action framework, as we call it. So that's one side. We publish portfolios on the Market Matters website, which members can go and look at. They can follow our portfolios in part or in full. We give a rundown of performance. We keep track of the performance. We provide a portfolio positioning report. We're very ingrained in the market, so it's not a passive sort of approach. We're active investors. We're managing our portfolios, and we're publishing those portfolios, and we're writing about what we're doing. In terms of Market Matters Invest, we have launched the ability for members and others to invest in the portfolios via a platform. It's called Market Matters Invest. It sits on the Open Wealth platform. It has investments are held through a custodian. The custodian is Link Fund Solutions, big ASX listed company. We're the investment manager on the portfolios. They're structured as a separately managed account. I can go into the intricacies of that, but ultimately it means that each individual investor has the tax benefits, has the same benefits of owning the underlying shares in their own name. So unlike going into a managed fund where you inherit tax liabilities and so on and so forth. My phone's going off. It doesn't stop these days. You're the beneficial owner of the assets held. There's 3 portfolios available for investment, and just a screenshot in front of you just gives you an understanding of the platform. And I'll show you a little bit more detail around that. The way that Market Matters Invest operates, this is simply a little graphic around where Market Matters Invest sits, how Open Invest is in the structure. They're the administrator of the service, and they're the responsible entity of the service. So they do all the administration, they underpin the platform, etc. All your assets are held through a custodian, so held in safe custody, and there is external auditor of the service. All of the docs around this are available on the Market Matters website. So I'd encourage you, I'm going to jump on the Market Matters website soon and show you where that is. But I encourage you to read the PDS and get a bit more information in terms of the structure and the intricacies of the platform and how we go about doing things. Just in terms of fees, always like to be transparent at Market Matters. It's one of our big things. We're transparent in the way we approach the market, approach our portfolios, approach what we charge. And that's a really important thing when we're structuring Market Matters Invest. The portfolios are charged at 0.85% per annum. No other charges. That's inclusive of GST, no other charges. In terms of a $250,000 investment, that'll cost you $2,125 a year, or about $177 a month. Transaction costs are zero, so there's no brokerage in this service, and there's no additional costs like administration costs, custody costs, etc. So that is a all-encompassing, fair, flat, transparent fee for this service. And this is a chart that if you've been on webinars before, it gives a quick rundown of our investment process. So we call ourselves top-down meets bottom-up investors. And what that means is, particularly when you're investing in large cap shares, we think the macroeconomic environment is really key. So we start at the top. We think about the macro environment and what's likely to come next in terms of the bigger picture, broader conditions out there. Last 24 hours has been a really interesting time from a macro standpoint, and we'll get into that very shortly, Shawn. We then think about the sectors that we want involvement in across our portfolios, and we apply targeted weightings across sectors, areas we don't want to be involved in given the bigger picture macro backdrop. We then dig in the stock selection. So we have a series of qualitative and quantitative screening mechanisms that we roll out. And then ultimately we create a portfolio that we're happy to hold. It is index aware. So we are aware of the index. It is a high conviction portfolios generally. So we're 20 positions in the portfolio thereabouts. But we do have an awareness of the index, but we're not index huggers. And we've got an active approach to the market. So we've got the Market Matters Invest solution is a really good investment platform, makes it easy for you. The investment process is a robust one managed by a great team. And I hope just in today's webinar, we will get a little bit further through that to show you sort of our views on the market and how we're positioning portfolios, the performance in the last 12 months and so on and so forth. I'm going to get to questions later. And in the meantime, I'm just going to jump on the Market Matters website. Was there any more that you wanted to add, Shawn, from a Market Matters Invest perspective?
No, I mean, I think you've really summed it up very well, James. A bit quicker than I thought you would. Actually, you've done this more than once.
Normally I dribble on, yeah.
Yeah, a lot of people do say to me when I'm speaking to them about Market Matters Invest, when do you mean by active? Does it mean you're day traders? How often do you trade, or how often do you invest? If I take a snapshot view, I would say we might move a position around every 4 to 6 weeks. Is something probably about accurate at the moment. It's obviously market determined. There's no often or less often, but we're not traders. We are investors. We've done some analysis, and we tend to perform better the longer we hold positions. But if we don't like a position, we did it last month, we are happy to scratch a position for break even. We don't have to wait for it to be up 10 or 20%. And that is one of the benefits of having no cost from commission.
Here's the this is just the portfolio that, say, the active growth portfolio that is available on the platform. So you can see some positions are relatively new, so added to the portfolio in 2024. We've got some positions from 2019, 2020, a little bit longer. So in terms of statistics around turnover, so when we're completing documentation, etc., we provide a guidance around turnover of portfolios. We're somewhere in the active growth portfolio about 50 to 100% turnover per annum. In terms of the income portfolio, it's about 25 to 50% per annum turnover in that portfolio. A little bit less in terms of the emerging markets companies portfolio, which has been going a lot for a shorter amount of time. In terms of, if you want to go and, if you are interested in Market Matters Invest, and I think that's why the majority of people are here, the best place to start would be to jump on the website. So you jump on the website, you go to Invest Online. It brings you to a page which covers what Market Matters Invest. The portfolio is open investment, and you can open an account very easily on this page. It will open up another window. You fill in, you complete your details. Takes a few minutes. One of the team at can help you with that if you so need that. The first place though I'd start is to get a really good handle on what it is around having an understanding of the product disclosure statement. So that runs through the key benefits of the offer, how it's structured, the fees, how it works, and all of those bits and bobs that you should be across when you're making an investment in anything, really. I think this is one of the, it speaks to, I guess, our view around the landscape out there for investment. I think it's really important, and we try to stress this at Market Matters, is about understanding what you're investing in. You'll notice that our portfolios are populated with a lot of well-known brands, etc., whether that's domestic or international portfolios. We stick to what we know, we understand, and we've got an edge in. And from an investment standpoint, I think it's really important to understand what you're investing in. And I think that starts with understanding the portfolio, understanding the people you're investing with, the business, what they're all about, and then understanding the product you're going into. That's a really important consideration. In terms of where I would go to next, if I wanted to get a bit more information on the active growth portfolio, and at this stage we'll run through some performance metrics. You can jump on the active growth portfolio. This is the active growth portfolio on Market Matters Invest. It won't have the portfolio there, but it'll have a bit more information about the portfolio fees. So I made mention of fees earlier, and I said that there was a flat 0.85% management fee inclusive of GST. There is reductions applied automatically for amounts greater than $500,000. So those reductions are on your screen there. So they will be automatically applied to your respective fee structure if that's the case. No brokerage charge on any transactions. And then from a reporting standpoint, and a few people have asked this so far around reporting, what do you get in terms of reporting? You get audited reports for your accountant, for your super fund, for whatever requirement you need those audited reports for, but they're sent out for tax time. On the platform, you can generate reports at any stage whenever you need them. And I'll just drop into here before I speak about performance, Shawn, and bring you in there. We send out monthly reports for these portfolios. And they are all listed and available, 21 on the website. So there's a full list of reports. The portfolios were listed through or available through financial advisors. The actual income portfolio and the growth portfolio has been available since 2018, but only through on the recommendation of a financial advisor. Market Matters Invest alleviated that need, and this is a direct-to-consumer offering. So Market Matters Invest itself hasn't been going as long as these portfolios have been listed on alternative platforms. So when we think about when we're publishing performance statistics, which will be each month in these Market Matters reports, which go through some of the aspects of the portfolio, key things we're looking at, number of holdings, major winners, losers, etc. We go through that on a monthly basis. The performance used will take into consideration the time the portfolios have been on another platform. Okay, so performance, Shawn. I've got to say, I'll put my hand up and say that 1 year numbers, so 13.3%, call it, for the year, a little bit above the benchmark. We're running about 5% ahead of the benchmark, and we came into the last 3 months of the year with some pretty significant underperformance for this portfolio. Run me through the performance for the active growth portfolio and how you're feeling about that.
Oh, frustrated, James. One never likes to give a bit back. If you want to catch me in a good or bad mood, have a look at the performance on the day and over the week, and that's pretty determines how I feel. The pullback, it's been very aggressive in the resources space, and then while we're not particularly overweight the resources space, it has got a high beta factor on the portfolio, and we've seen some big pullbacks in coal, with big pullbacks in uranium, and the likes of BHP. And that's one of the questions we get asked all the time. When is the time to buy more resources? When is the time to buy more resources? I think we've already been asked that question today in 1 or 2 formats. And we're holding true to what we're holding. We haven't increased our exposure. It's one of the things I want to go through in a minute with the likes of BHP and iron ore, etc. But we're very, very bullish copper, for example. So it has been frustrating, but we're in this for the long run. We're not looking at portfolios month to month. Of course we do, but it's year to year that matters. We've given some back. There's been a bit of reversion as it's been very aggressive against the, as I say, against the resources, but we feel that still will turn around, and we haven't cut any of those positions.
Yeah, we don't want to be too negative. I mean, at the end of the day, what's really important from a portfolio perspective is incrementally, booking strong performance and not having big periods of drawdown. That's the key, and doing that over time and repeating that process. So having a process that is repeatable over time is the key to performance in the market, and that's certainly what we've been focusing on around over the past 10 years, developing a process that works and is repeatable. So I'm going to get onto the specifics around sectors, stocks, and how we're positioning in the market very shortly. Just in terms of looking a little bit further into other portfolios, so the active income portfolio. This is a portfolio that is a lot more, I guess, it's less active than the active growth portfolio. It's more consistent in terms of the income it produces, and it's got a lower volatility or a lower beta to the market. It does that by holding. This is actually going not in Market Matters Invest. I'll go back to Market Matters Invest. We'll go into those portfolios shortly, so I'm not trying to not show you those. We'll go into the portfolios very shortly. The income portfolio holds high yielding Aussie equities, hybrid securities, some listed other debt instruments, and it's got as I said, it's got a lower beta, higher yield, more consistency. So if I look at the volatility metrics, and we do this, we had a question over the weekend around analyzing the volatility metrics and different scores for portfolios. This portfolio has got a really low volatility score, so it shows you around the consistency and the ability to hang your hat on the returns. The returns are lower. There's no two ways about that. The returns will be lower in this portfolio, but they'll have a lot lower volatility as well. They all have the same. They all get a monthly performance report, etc. They're sent out via email, and then we run a webinar often, and we talk about how we're progressing. And this is a newer portfolio. The emerging companies portfolio hasn't been around for as long, hasn't got as strong a track record in the last 12 months as the active growth portfolio, but we're building on this, and we're working very hard around the emerging companies portfolio. We made some reasonable changes to it in the last week or two, which we think are going to deliver performance in what comes next in terms of market. So that's what I want to get to now, Shawn, around what comes next in markets. I'm just going to jump into our portfolios just quickly while you start talking about that. So I just want to outline how transparent we are. So the Market Matters Invest service is aligned with these portfolios. There can be some very slight variances around around weights, etc. But broadly speaking, the underlying Market Matters Invest portfolios, this is what you're getting. So this is the active growth portfolio. Market Matters Invest, the active growth portfolio came to be in 2016. And has done 14% per annum since then. And that's the portfolio that Market Matters Invest mirrors. So 20 positions, warts and all shown on the portfolios as always. And we'll always give you updates around positions. We wrote about JB Hi-Fi this morning as a position we bought recently. And if you dig into the JB Hi-Fi page, you'll also get a good rundown of all our latest views and a history of our actions on any particular stock that we're holding and other stocks that we're not holding. So that was the active growth portfolio. And then the active income portfolio, I'll just bring that on the screen there so you can have a quick squiz at that. Then I want to get into some macro and stock specific thoughts for listeners out there. So you can clearly see we've got some hybrids, some high yield equities. We've got a pretty dud position in Fortescue. We only took that on at the back end of last month. We're down 11% on the back of that. We bought it for income. You buy a resource stock for income, and then it drops 10%. So that's what you've got to be, eyes up footy in terms of that respect. We're still comfortable with that position, just so you know. 4% weighting, relatively small. And then that's the rest of the portfolio. So I like that portfolio, like all the Market Matters portfolios. Shawn, let's dig into some macro views.
Okay, normally everyone's going to expect me to start off on bonds and interest rates.
Oh, look,
but I'm not going to.
I typed it in.
Well, I wasn't going to, but no, put in BHP. I want to go off piste a bit. Let's look at BHP because it is where the questions are, and you've mentioned Fortescue before. It's very important that potential investors understand that we look to tweak portfolios. It's a word I often use. We sometimes use in the reports. So I had a person discussing with me yesterday, why are you still holding BHP? It looks horrible, etc., etc. We've only got 8% in BHP in the active growth portfolio. We haven't got any Rio, and we haven't got any Fortescue. So of the big three iron ore miners, we only own 8%, which is half. Basically, they equate to about 16% of the index, which is obviously, we all know, a significant portion of the index. It's actually quite amazing that I'm looking at a market that's been to 81.48 today, yet the likes of BHP and Rio are both down 15% this year. If you told me in January they were both going to fall that far, there's no way I'd have said the market would be at 81.50, but there we go. That's why you have to be open-minded when you look at markets. So, we are looking at when we feel the time is right to increase these. As James mentioned, we bought Fortescue for yield, but we're not in any hurry. We are holding them. We are market conscious, as James said. We are index conscious, but we're comfortable in that particular space to be underweight. There will be a time, maybe when BHP is down around $38. We've mentioned it a few times. James is showing you there.
Yeah.
Where we might well increase BHP up towards 10%. But we've been very patient towards this. But for us to have no BHP, no Rio, and no Fortescue would basically have us ignoring 16% of the overall index, which is a really big commitment. Does that make sense to you, James?
It does, mate. So just to reiterate our views around commodities. So we've got, if you go back to the active growth portfolio, you can see we've got a number of commodity positions in that portfolio. In a nutshell, we're bullish on copper, we're bullish on uranium, we're bullish on coal, and we're bullish on gold. So those four key commodities that we're particularly bullish on. Obviously, BHP has some iron ore exposure, which we're not overly bullish on, but we think the market is overly bearish on. So consensus price expectations for FY25 on iron ore is $85. It's trading above 100 at the moment. If that doesn't materialize because China goes out and stimulates more than, China goes out and stimulates, can arrest the decline in their economy, then the market's already positioned negatively for that. So you'll see some re-rates on the upside for some of these miners. BHP may not get to $38. That's the other thing that's important, Sean. But we're there. We've got an 8% position that we're happy with. We would average it if it went down below that level, but not before.
Yeah, and also you've got to be flexible when you look at stocks. You know, we're not trading futures contracts where 1 point here or there is that important. You know, BHP at $40 the day before it trades ex-dividend is the same as BHP at 38. You know, a lot of people forget that. You know, there are several parts to this puzzle. Basically, the price isn't as important as how we would determine at the time whether we think the Chinese outlook will improve. But we are being fussy. And as James said, we're very bullish on copper. You know, we are bullish on the energy sector. We've chosen to go with coal and uranium there. And that's a very high beta, very high volatile part of the market. But these are cyclical plays. We do see a lot of movement in them. And that's what has weighed on performance in the last few months. But if we had no position, James and I'm sure within a percent would have the same positions going on today.
Okay, so just to give you an idea, and I want to get on the bond yields because it has been a big 24 hours for them. We do focus on them sometimes too much, but it has been a big 24 hours for them. Just in terms of why you like particular commodities, so it's either supply and/or demand led. So what I mean by and/or demand, so if supply is weak but demand high, obviously prices go up, but they're not all going to be predicated on that. So gold's obviously a hedge against future instability. It's a hedge against falling US dollar, which we think will play out. So gold continues to look great, and it's one of the things we've made money out of in recent times. Copper is a demand exceeding supply in the coming years story. The same is true for uranium, but coal is about supply, I guess, not keeping up with the near-term demand. So we think the decarbonisation thematic trade movement to net zero is going to take longer than anyone thinks, and that's going to provide support for or demand for coal in the next 5 to 10 years at least. And there's no new development coming online. So supply not meeting the demand response over a particular given time frame. So that's I guess our key thinking around that. Bond yields in the last 24 hours, Sean. CPI data yesterday in Australia, taking rate cuts off the table. What are your thoughts there?
Totally. And I've deliberately come onto this second because as you and a few other people tell me I talk about bond yields too often. We've been saying for quite a few months now, we don't think the RBA want to hike rates. And we went as far to say on a regular basis that we felt that the next move by the RBA, by Michelle Bullock, would be a cut. I mean, she's got a much, much harder job, of course, than Jerome Powell, that's looking at probably going to start cutting in September. So the market's looking for 2 rate cuts by the RBA by about May. Hopefully one, the 50-50 or better than 50-50 chance of a rate cut now looking at going into Christmas. I think we are going to get rate cuts. I think we will get 2 by the middle of next year. I wouldn't be surprised if she hangs back before Christmas, but then we're going to have an election next year. If she cuts twice into the election, I'm sure Mr. Albanese will be very happy. But at the end of the day, elections aside, the inflation picture is improving. The economy is a bit of a patchy area where some parts of the economy still look very strong and some parts look very weak, as we all know. If you look at the price of the house next door, you'd think we were in a boom time. But I think interest rates are going lower. I feel the market is now starting to really embrace that, especially locally in the last 24 hours. We've gone from worried about a rate hike to saying, okay, rates are going lower. The Aussie dollar has dropped 10% against the Japanese yen over the last 2 weeks. There's been some really, really big moves on financial markets. And we've tweaked our portfolios accordingly in the last 24 hours.
Yep. I was going to say, I was just trying to find a chart that we had put, it was meant to go in the afternoon report yesterday, but it didn't make it. So it was around interest rate expectations. So we look at futures markets. So before yesterday's CPI data here locally, we had, there was about 5 basis points of tightening priced into the market. And post that number, about we're starting to get a 60 to 70% probability that they will cut before Christmas. So Shawn alluded to what was playing out in the US. Jerome Powell's testimony or decision to do nothing last night, but the commentary was really important. So basically, in the last meeting in July, he said that they were looking to gain more confidence that the inflation picture was heading in the right direction. Overnight, he said that they had gained more confidence that the inflation picture was heading in the right direction. So they've opened the door for a cut in September.
Yeah. The minute he used that word September, the Nasdaq rallied almost 2%.
Yeah,
they just jumped straight on board. A bit like our CPI yesterday. They embraced it big time, and they've started to price it in.
Yeah, exactly right. So we talked about an active nature of portfolios. So this morning we flagged a couple of potential switches in our portfolios over the coming weeks or so. One of those we've pressed the button on this morning, which is going into, and if you want to see the alerts on the site, you simply go to the alert section, click on the alert. So this alert was sent out this morning. Looking at what we're doing. So we're actually taking a very unpopular decision this morning, I'd say it is, around Goodman Group, selling Goodman Group and buying GPT Group. So Goodman Group is your pin up in terms of property exposure. It's up, in 12 months, I think it's up 70%. I know it's up sort of 40% year to date. One of the things that we're a little bit concerned about in terms of Goodman is how much the market is extrapolating this movement into data centers. So obviously Goodman Group, phenomenal operator, phenomenal leadership, great company. We love it. But the market, like they've done in AI over in the US, we think about a theme and then we believe that theme is going to generate earnings straight off the bat. There's obviously a time lag between going into a new area and generating sustainable earnings from it. So Goodman's expensive. Being expensive is not a reason to sell, but investing is a relative game. So if you can take a relatively expensive exposure and add it with a relatively inexpensive exposure that we think in the immediate term will have more upside for a whole bunch of reasons that we've been covering, then it makes sense to us, Shawn. And the other one we did speak about this morning.
Sorry, James, to interrupt. Just on the Goodman Group, and I'm reiterating what James said, it's a fantastic company, but it's trading 20% above its average valuation of the last 5 years. So it's rich even for a stock that's often rich because it is such a good stock. But as James said, we have got a situation where a lot of good news is baked in the cake. It's up 40% year to date. GPT is only up 1%, and it put on that 1% yesterday. So that we think that we're going to get some reversion between the two. Plus, we get the yield from GPT, which Goodman Group doesn't give you.
Okay, I want to caution relative valuations over 5 years, and this is Shawn. You're quick to stick the boot in terms of analysts' views around banks, CBA in particular. You love writing that they all have sells on, and they certainly do. One of the reasons why they have sells on banks is relative valuation anchored to the past. Okay, so things in companies, and this is important for listeners out there, things in companies change. So if I'm playing devil's advocate around the banks, and if I use CBA as the obvious example here, so why have banks continued to defy bearish analyst expectations? My view would be that is the wrong MM is bullish PRU. That's been tagged in the wrong area. So apologies about that. So why are analysts wrong on the bank? So if you think about what a bank does, it's all about volumes. So it's about getting loan growth. So lending money. It's about getting deposits, so financing that lending, borrowing money in the market. Whatever the case, it's a high volume business, high volume, low margin business. The biggest thing that can improve the earnings of high volume, low margin businesses are efficiencies. So if you think about efficiencies predicated on AI, I know it's a buzzword and I hate getting caught up in the AI hype, but it is a really valid area of how the banks can improve efficiencies and improve margins. And that's perhaps, you've got to think outside the box investing. That perhaps is why the backward looking analysts anchoring to valuations over a given time and saying that they're expensive relative to history and not seeing what the buy side analysts are seeing. So sell side analysts work for brokers, investment banks, etc. They're providing research and getting paid through brokerage or fees or whatever's the case. Buy side analysts are internal analysts within funds who obviously have got a lot more bullish appetite or expectations around the banking space. So, and we probably sit somewhere in the middle of that. I hope that makes sense, Shawn. But I just wanted to highlight the innate, I guess, issues with just anchoring it to a historical valuation and where it goes wrong.
No, absolutely. And that's when you got to factor in, you got to say, okay, Goodman Group's up 40%. It's trading rich compared to the last 5 years. We think it should be, but can it do another 10 or 20%? And that's when you start questioning it.
The hard thing is valuing the future. Valuing the past is very easy. So it's valuing the future. So thinking about what the future will have and then valuing that. So clearly, Goodman moving from a business focused on industrial development, obviously a very good one, a huge, vast array of capital partners, deep understanding of the industry they operate in, great partnerships, the likes of Amazon, etc. Moving into higher value data center strategy, that should have a higher value. There's no doubt about that. What that higher value is. So I think Goodman will continue to trade expensive, but it's about the lag effect between when those earnings will come and where it's trading at now is why we're taking a little bit more of a cautious approach to Goodman Group. So banks. The other thing I'd say on the banks, Shawn, and I haven't spoken to you about this, but it was around, so I was asked a question yesterday, what bank would you sell? And we own this one, it's NAB. NAB is up 34% this year. ANZ's up 11%. Obviously, ANZ's got some issues around the acquisition of Suncorp, which is now bedded down, plus a few other regulatory issues around rigging of pricing, etc., which I don't think is a major issue. The reason I target NAB is that NAB's business bank is the jewel in the crown. There hasn't been a time in history where it's been challenged as much as it is being challenged now by CBA. CBA is really pushing into the business banking space, and I hear they're having some luck in that space, generating, bringing on market share. And you can see it in the initial numbers in their business banking space. So NAB is something that will be on the up for discussion in future weeks for us.
Yeah, and
Shawn?
I think it's fair to say that CBA don't do many things badly. History has shown that, whether it be the first person to really get on top of tech, they do things very well. And the banks are also benefiting. One thing we didn't mention very quickly, James, is they're benefiting by the branches closing. They're benefiting by the movement away from cash towards credit cards. All these general trends that are washing through society. They're also benefiting from the immigration numbers, although that might be slowed. Yeah. That might be slowed down. It's a bit of a political football, but there's quite a few things helping them, and people are happy for the safety and conservative nature of the yield of CBA to think, well, it might be a little bit rich today, but in a year or two's time, it will all caught up.
I totally agree with what you're saying there. I don't want to sit here, cheerleading for the banks in any stretch. I think there's a real case to be. I wouldn't be a buyer of CBA, NAB, Westpac for that matter at these levels. So then you run through what comes next. So we're not for a growth orientated portfolio like we've got. We're not we're not against reducing our banking exposure and being really underweight a space that has run hot. So we're not against that in the slightest. I'm going to crack on the questions because it's got here and there's questions on stocks and questions around sectors and all of that. So I'm going to get those over the line now while we're talking about from a markets point of view. Then I'll go back and there's a few questions on the specifics of Market Matters Invest. And so I'll answer those at that point in time. There's one here just around what's your favourite bank? I think have we covered that, Shawn?
I think we had. If I had no position right here, right now, I would probably be leaning towards, if I was being speculative, Bendigo in the smaller space, because the small caps, they're all benefiting more. In the big four, I'd probably be going. It's hard to say. Maybe ANZ for catch up. Maybe CBA to keep it safe, because I don't want to buy any of them right here.
I think that the two that I would back is ANZ relative valuation. Things will work out from a shorter term perspective. They generally do, and CBA is the sector leader, predicated on their huge investment in technology over a long period of time, and they're in the box seat to take advantage of the benefits of any efficiencies coming through AI. They would be my two if put on. I don't think there's any need to be in the regionals. Are you still confident on resources, and what are your best picks? So we've covered BHP. For me, we've covered copper, coal, uranium, and gold. Have a think about best picks in that area, Shawn. I know
My
what I
favorite,
choose.
I would choose copper all day long. And I would choose Sandfire. I don't think it's as good a quality company as Oz Minerals was, but BHP's already bought it. Sandfire's knocking on the door of $9. Sure, we all know it popped above 10. The copper price has dropped over 20%. Sandfire's only down about 10%. These are round numbers. BHP's still trying to increase assets in copper. I don't think Rio will be far behind. I think the copper space is going to be very, very well supported in the coming years into any dips, but I could see a lot of upside when we do see some China recovery. So I think the copper space, from a risk reward perspective, I like still very much, whether it be here or overseas.
Yeah, right here, right now. So I like, I agree, Sandfire, number one pick in the resource space right now in the large cap complex, trading just below $9. It's put on 3% today. It was up strongly yesterday. The reason I like them particularly is around their increasing production right at the right time. So I know copper's gone from above 5 to now testing. It's tested $4 a pound, and it's now sort of circa $4.20 a pound. Ultimately, the copper price will go higher, and Sandfire will be a leverage exposure to that increase in the copper price. You'll note up here that we've got MM selling SFR in the emerging companies portfolio only, taking profit around 8.16. So that might go, why are you selling it when it's your most bullish position? Speaks to portfolios and what is right for each portfolio. So we did a straight switch into a company called AIC Mines, A1M, which is more of a junior copper play. So 4% around 33 cents. That is a smaller cap copper company we think has really strong upside and more leverage to the copper thematic. So that's a 200 market cap or thereabouts copper company that, for those more speculative investors, like our emerging companies portfolio, targeting those growth companies, it's more relevant for that portfolio, but it wasn't a view on Sandfire one iota. So we're bullish on, we're maintaining the rage on commodities. So I don't want to be it has hurt us in the last couple of months, but we see no reason to run from it at the moment. Uranium prices are really interesting. Paladin is one that I think is really topical, Shawn.
Absolutely.
I'll just bring up, at the time they did, so we've been uranium bulls for quite a while. We took profits on Paladin, and then we've bought back into it a little bit too soon. We still maintain that this is a good company to buy, but the thesis has changed in the last couple of months as they have made a move on fission over in Canada. So this was Paladin were developing the Langer Heinrich mine over in Namibia. Held for a long time. It had been under mothballs. Uranium price rallies. They get the mine up and running. They're now in production. They're now selling product. And that's a time where, so the prices were low. They couldn't do anything with the mine. Prices rallied, they could do something with the mine, and they had a really valuable asset. What they've gone now, and it was going to throw off a lot of free cash flow over the coming years, what they've gone now is upspec and increase their bet on uranium, buying or trying to buy fission after uranium has run. So it changes the whole dynamics of it. They're going to have $850 million worth of capex to put into fission over the coming years. So this free cash flow coming from Langer Heinrich is going to go into taking on more development risk, if you like. So it goes from a really simple uranium story into a more complex uranium story. If uranium runs from here, then obviously they've got a bigger exposure to it. So it'll be better for Paladin. If it doesn't, it's a high risk proposition. So the risk dynamics in the Paladin position have changed a little bit. However, we're still, we're bullish on uranium. So we need to maintain a bullish stance on Paladin, albeit with a few more caveats, Sean.
Exactly. It kind of reminds me of Whitehaven. They've doubled down on their coal exposure by buying a lot more coal. They've gone from being a cash cow to being a longer term investment play. But again, if we're right on both commodities, they both will be very well positioned in the coming years.
So and we haven't, like, these are two things that have hurt us in the short term, Sean. There's no doubt about that. So companies that are betting bigger on a theme in the short and going out there and buying something in the short term, they've underperformed. So it's a lesson out there around companies going and buying stuff that can have a negative impact in the short term, and it's something we probably should have thought more about in both of these scenarios when they played out. But ultimately, the more medium-term view overcame the concerns in the short term, and we think if the view around coal, if the view around uranium plays out, then these are going to be more leverage plays on that thematic. Particularly, Whitehaven's gone from a primarily thermal coal exposure into a more met coal exposure used in steelmaking and all the things that we need in the this huge global decarbonisation that we're going to go through. And I think that's one of the things that we're still bullish on, is around the global decarbonisation that's is taking place, etc. And we think will continue to take place. I'm going to move on to just a couple of quick questions on the Market Matters Invest, and they're all building up. Does the portfolio get set in one go when I put money in? Yes, it does. So you put money in, it goes and gets set. There's no brokerage charged, and it goes and gets set on that day. Do I get tax reports? Yes, you get audited tax reports annually, so it packages it up in a nice bow for your accountant. Can I invest across multiple portfolios? Yes, you can. You can select one of 3 portfolios at this stage. I don't want to say it because it's come to bite me so many times. The international equities portfolio will be on there at some point. I was about to say soon, but I won't say soon.
You can actually, you say one of 3. Of course, you can invest in 2 or 3 or all
yes.
3.
Yes. If the US, Arthur's asking, if the US cut interest rates, surely Australia will do the same. Otherwise, the Aussie dollar was spiking against the US dollar. How do you see the scenario playing out?
I think they both will cut interest rates. I think that the US will probably do it in September. Jerome Powell didn't just throw the word September out there without a lot of thought. Whereas I think Michelle Bullock still wants to see some more numbers come through. Whether she cuts before Christmas, the market's 60-70%, as James said. I'm more 50-50. And I think she'll be cutting next year. Yeah. But I do think we'll get the 2 cuts by next May. Where the first one is more questionable.
Yep, I agree. The key scenario, Arthur, is that the US will cut more than Australia in a shorter amount of time.
Exactly.
So that will be the key takeaway there. But both will cut. I came home last night and my wife talked about the inflation print that she's seen on the news, saying, "Gee, inflation's still an issue. They're going to raise rates." And we've had a few clients have come through this morning saying what the media is publishing around inflation is not what there's a disconnect between the markets. I would believe the markets over and above the media, and the market is telling you that there's a high chance that the RBA will cut rates this side of Christmas, if not early in the new year.
Yeah, the media, unfortunately, is just fueled by clicks.
Yeah.
So the more of a headline, glamorous headline they come out with, or shocking headline, the more clicks they get. That's what they're promoting.
When are the audited reports available for your tax returns? Approximately 3 months post FY financial year end. So the reason for that, property trusts, etc., take a while. They pay dividends right at the end of the year, or go ex-dividend right at the end of the year. So you get all the statements through, they reconcile those, it goes to the auditor, and then you get them generally 3 months after year end. Do you use stop losses in your portfolio management? And if I was in your managed portfolio funds and I wanted to sell part or all the portfolio, is there a time delay? Many thanks. Okay, so we don't use stop losses. We have points where we test our thesis and see if it's broken, and then we'll exit it. But we don't have arbitrary stop losses in place. We don't believe in them. Selling a stock just because it's down 10% or just because it dipped below its 2 times average true range, we think is too much of a arbitrary level. The other thing around stop losses, my personal experience, if I'm trading systematically, so the reason I enter a stock is systems based, then you need a systems based exit. When you're not entering a stock purely on a systems base, so it's a combination of macro, fundamental, and quantitative aspects, then having an arbitrary stop loss doesn't make sense. Did you want to?
No, I agree.
Anything
100. I agree 100%. I've traded currencies in the past as well. They're 24 hours. If you're trading something that's 24 hours, the stop loss can be relevant. How can you have a stop loss when the stock can open up or down 20%?
Yep. Okay. So if I was in your managed funds and I wanted to sell part or all of the portfolio, is there a time delay? There's not. So it's structured as a separately managed account. You redeem your money as soon as that redemption. So you do it online. You can do it online via the portal. The next day, say you've got 100,000 in a portfolio and you want to withdraw 50. Each position that you hold will be reduced by 50%. The funds will go back into your account and you'll have them within 5 days. Ken's asking, what's your view on Audinate? Ken, I'm a little bit nervous about Audinate, to be honest. So we've got a 6% weighting in our emerging companies portfolio. And what I think about that, I think they report on the 16th or 17th or thereabouts in August. Couple of things since they, in recent times, they've obviously dropped from above 20 to now be trading below 14, below 15, I should say. We've owned it since 21, so we've done well out of it. Rob Goss, CFO, left, had multiple calls with Rob and the broader Audinate management, who did a good job of trying to say that there was nothing to see there. We've heard through channel checks that there's some discounting going on. Ultimately, my view is I'm a little bit nervous going to this result. So if I'm nervous, having a 6% weighting is probably too much. I still want to be there. We may look to trim our Audinate holding in the emerging companies portfolio. Just thinking out loud. How about silver, Shawn? George is asking.
We like precious metals. I like them over the coming years, George. I think that if gold starts pushing up another $50, $100, we might even take a little bit off the table. Something we've spoken about a few times. But if interest rates are going to push lower, the bigger picture move in gold and precious metals should be up. Silver's a little bit different. Obviously, it's more of a used commodity than gold. But it will go in tango. But it hasn't. We don't watch it as closely, George, because it hasn't got the same exposure with stocks here.
Yeah, exactly. There's very few silver. So SVL, as you've made mention of, George. Yep. On the MM website, is there another way to add a stock directly from the hit list rather than the search function? You can, in the portfolio screen. So if I go into a portfolio, I've got a question here on a international AI stock, so I'm going to cover that shortly. I'll go into the international portfolio now to showcase that. So we're going to talk about Microsoft for a sec, because it's just a question on AI, but I'll kill 2 birds with 1 stone. So if you go in and go to the company page for a particular stock on the MM site, you can go add to hit list, and that'll put it on your hit list. That is a way of adding stocks to your hit list. And the same is true on the report. So the reports will have the morning reports, for instance, will have a series of, see that excerpt wasn't done, Shawn? I didn't do that. this
Mm-hmm.
morning. There you go. There's an example. These companies, that'll take you to the company page. If you're reading the, whether or not you're reading the morning note via your email or via the website, you can click on that and it'll take you. Then you can, I've got iLuca on my hit list, so you can remove it or add it to your hit list. So just AI stocks. So there's a question here. What do you views? What's the best way of investing in AI locally or overseas? I'm going to start just on overseas for one sec, Shawn, and then you can have a crack locally. I think Microsoft is the best way to access AI overseas. You think about, so Microsoft reported this week, the stock got sold down. I can understand why, but if you think about Microsoft as a business, they've got a really diverse customer base. They've got, so from corporates to individuals, etc., real diverse. They're really up and down the tech stack. So they're big in the cloud, they're big on applications, they're big right across a broad spectrum of things that will be impacted by AI. So to me, they're front and center on the play of for AI. If you think about Nvidia's earnings are really correlated to how much the big tech companies are spending on their push into AI. For them to continue increasing spend, they need to start to see financial results. Like Meta reported after market last night. They said they're increasing their spend towards AI. Google was a little bit more muted, and that's why Nvidia and the others fell. So I think there's, Nvidia's at the pointy end. We did write an article you find on the website around Nvidia saying where would we buy it, and we said something below. I think from memory it was 105 to $100 a share, and it got there in the last couple of days. Did you have any thoughts domestically, Shawn, seeing as we're just selling Goodman today in the market?
Good timing. I think you've got to look upon a little bit broader in our market. We haven't got the juggernauts of the likes of Microsoft that can really beef up that side of it. So you've got to look at the knock-on effects of AI. Data centers obviously is very important. We mentioned that this morning. We talked about next DC maybe is a better place to have exposure at current levels. It had a big pullback, a lot of it in sympathy with NVIDIA. These are very, very volatile stocks if they're getting linked to AI. And then you've got the energy providers. AI uses an enormous amount of energy. The sort of numbers involved are hard to comprehend. And we've got a position in AGL. We talked about APA this morning. Any utility, whichever way they are, any utility involving energy could benefit at some point in time in the cycle. So I think we have to be flexible on the local market. It's a bit different to the American market, but it's going to make and break some companies from a performance perspective.
Absolutely. This is an article we wrote on NVIDIA 26th of the 6th, so a little while ago. Now, basically, the conclusion was that 105 makes sense around 105. I was looking at NVIDIA this morning, right? So they have come back to sort of near the lowest earnings multiple they've traded at in the last 5 years. I know I just said be careful around using that, Shawn, but that is the case in the last, when it dropped down, the risk reward looks better for Nvidia into the pullback that it's had. So we'd flagged 105. The fact that it's corrected, met strong buying and rallied is actually a really good technical structure for Nvidia. So we like that as an edgier play, but it is a lot edgier than a more diverse Microsoft. So if you're boring, and we're a little bit more boring in our international equities portfolio, then Microsoft would be the way to go.
Yeah, or you buy less.
Yeah, exactly right. So if we were buying Nvidia, we would go in and have a 3% initial weighting, and then look to add to it over time. Here's just a quick overview of our international portfolio. Relatively speaking, we underperformed last year, just so you know, 4% below the index. Just on that, so 30% of the S&P 500 is made up of 7 stocks. In the last 3 years, the S&P 500 would have done 5% per annum if you took out those 7 stocks versus the ASX up 8%. So our 17% per annum since inception is really positive. So we like this portfolio. We're trying to get it launched on Market Matters Invest. So it can be open for investment. So we're continuing to work on that. I'm going to wrap it up there. We don't have time for any more questions. Oh, there's one just on fees. So, and I just want to stress this. Are there any other fees to be aware of other than a portfolio fee? No. So there are some, if you transfer equities out of the platform, I think there's a $30 transfer fee or $35 transfer fee. If you're moving equities yourself, so rather than cashing out of them, and that would be that's the only additional fee. So there's no transaction fees, as I said. There's no reporting fees. There's no administration fees. There is no additional fees that you should be aware of. No performance fees. So it is 85 basis points, all wrapped up in a nice bow. So if you want to get more information, jump onto the website, as I said. Invest online, portfolios for direct investment. There's a bunch of information on all of the things we've spoken about. Make sure you read the PDS, understand what you're investing in, understand the people who are investing your money. That's the important thing. And know that if you're doing it with Market Matters, you'll get a really transparent service. Our focus is on performance. Our focus is on delivering well understood portfolios, actively managed, targeting out performance over time. So anything you'd like to add before I wrap up, Shawn?
Yep, just one very quick thing on fees, because I'm asked about it a lot. The other side of the coin is positive. If you put in more than $500,000, the fees start to come down. If you put in above 250,000, you get a free Market Matters subscription as well.
Good point, and something that I didn't mention. So that is a good point indeed. So we've had a lot of people on the webinar today. Thanks very much for your attention. Thanks very much for joining Market Matters. Great to share what we're doing with you, share our views in the market. We do it once a month, and we'll continue to do this as and when we can. Thanks for joining us, and thanks for your interest in Market Matters.
Thank you.
See you guys.